All right. Hello and welcome back to the ROI Club, guys. And today we're going to be responding to the questions I've had around the offshore sector. Disclaimer, nothing I say is advice, of course. I'm just a guy who shares my thoughts with the world. And the good thing about that is that I have them documented and I can go back over time and I can make adjustments to see whether things are working out as planned or not. So, what we're going to cover, disconnect between price and value. The offshore drillers have been smacked down over the past year to date, definitely, but actually over the past rolling 12 months. Fundamentals are looking pretty good. In fact, I don't think they've been stronger anytime soon. And if you take into consideration the balance sheet that these guys have really cleaned up, I think this is probably the best the sector has ever looked. Fundamentals, so we're talking about why I say that. In brief, the day rates are continuing to increase. They've kind of slowed in terms of the rate of their growth, but they're still very, very decent. Put it this way, in 21, 22, we were still we would have been happy to take these day rates that we're seeing now. Backlogs are being filled up. Utilizations rate will probably finish the end of this year at 90% or slightly below. And supply still remains tight. And the most important thing, new builds not on the horizon anytime soon. I'll briefly cover the market moves, but remember that's price, and I'm interested in value and the opportunity. Tidewater, Valaris, and Bohr, in my opinion, don't reflect the reality, and they've got a large asset backing with their pristine balance sheets. Bohr's got a little bit of debt, but it's really nothing to write home about. I'll touch on Transocean as well, and say why I feel differently about it now than I did as of sort of 5 years ago. Guys, subscribe and like if you want me to continue cranking out the video content. So let's take a look at presentation today. If you've if you've been in this thing for a while, like I have, you've been interested in the trade for a little while, this is what you've been looking at basically. So 5 years we had COVID, and over that time, surprise, surprise, those guys that went through and cleaned up the balance sheet did the best. If you were a buy and hold investor, if you were a degenerate like myself, buying call options on rig when it was less than $1 and having those come to fruition, you obviously did very, very well. But over time, this is a capital cyclical business, intense business, not a good business. This is a special situation, and that's why it's got a certain proportion of my capital allocated to it. I will not be holding these guys forever. Tidewater, Valaris, but really the layups in the space. Transocean, I guess you could think of as more of a 3-point shot. So if you look year to date, Valaris has been smacked down along with Tidewater. Transocean basically the same, and then Bohr has really, being a pure play on jackups. Jackups are really on the nose at the moment, so it's lost basically half its price over the last 12 months. This, however, is the chart you need to worry about. So this is the only thing that matters in terms of charts right now, as far as I'm concerned, in the sense that it's the most important thing. Order book as a percentage of the total fleet. When you see it getting up high, where we were around 2014, 2015, you won't find me in this trade. Okay, when you got a whole heap of new supply coming online, unless all of a sudden miraculously we're not going to use oil, that's the thing you want to keep your eye on. So as you can see here, we're at one of the lowest times in history. We'll see what happens, obviously, with the Permian, whether the rollover really does take place. I think that it will, unless we get much higher prices. And if we get much higher prices, how much more attractive are some of the offshore plays going to be? Those are the things that are on my mind as we look at sort of Q1 2025 being wrapped up. So the rig count, this is from an article, quite a good article. I've left the source there, and you can see where we're at in terms of the day rates and in terms of the rig forecast. Okay, it looks like rigs mostly around the world are going to contract. A little bit of growth perhaps in South America, maybe in West Africa, but 2025 we won't see the same amount of new rigs being deployed unless we get some oil price action. Some of that may be due to geopolitics, which does follow this sector. So if we do get a peace deal with the Russians and the Ukrainians, then perhaps it still doesn't mean that Russian oil will magically start to be acceptable again, but maybe that's what's driving some of the sentiment. I don't know. These rates here, we're probably going to finish, pretty much between the middle of the two estimates for 2025, which again, no one's going bankrupt in this situation. So panic stations really are way overblown. Calls for panic stations, in my view. This is a very instructive chart. Okay, why is it instructive? Because I want to make something clear. When I talk about being an energy investor, I am not, or liking the oil trade, I'm actually not long oil at all. At all. What I'm long is oil capex. And I want to make that very, very, very clear. Okay. So the light blue here is what we're interested in from my perspective, at least. So we're starting just to tick up in terms of the amount of capex expended by the majors to getting this stuff to production, and that's onshore and offshore. So onshore, I have my select oil services plays, and I have my land owners with royalty holders. That's my biggest position, really, that I think is the best way to play this reversion, along with the special situation that is the offshore sector, given that they've just been through a bankruptcy cycle. Okay, if they still had their debt load, probably wouldn't be as attractive to me. But because we're getting this, as our friend Trader Ferg says, subsidized asymmetry, the shareholders from past cycles, when they did go bankrupt, with the exception of Transocean, they've kind of done us a favor. They've recapitalized the capital stack, and we've got this pristine balance sheet. So that's de-risked things quite a lot. Utilization rates today are much higher than where they were in 2017, so that's good. Balance sheets are the big difference for me, so debt is not really an issue unless you're Transocean at the moment. And if you look at the M2 monetary supply, inflation and through the cost columns of most of the producers is starting to run rampant. So it's just simply they're going to have to come to the table lifting these day rates, lifting these capital expenditures if we're to get the oil that we so desperately need throughout the world. In addition to which, a few little things have occurred between 2017 and now, such as the depletion of the SPR, and I think that that's no small thing in light of global inventories that are also super depleted. So what's going on with the prices? Well, I guess you can take my attitude, which is I really don't care so much about the price unless I can buy in, but I know that's not really answering what you're asking. Misconceptions. So it is, make no mistake about it, it is a cyclical boom bust industry, but this is not the same industry that it has been in the past, mainly due to the bankruptcy cycle having already occurred. And the geopolitics have touched on. If Iranian sanctions are actually enforced under the new US administration, I think that people are underestimating the effect that that will start to have on transport and where oil is produced and carried to in the world for its refinery. And a really big point is that capex discipline is real from the majors. We just saw that the majors are not spending as much of their cash flows via capital expenditures to grow. They're retiring debt and giving returns back to shareholders. And eventually we'll still need to reinvest in this particular business. So whilst that capex was going on a couple of years ago, while the shareholders' returns were looking really good for producers a few years ago that had drilled and uncompleted wells, that was when, you remember, I was long Ecopetrol, Petrobras in some serious size, okay, because it was benefiting from that shareholder return program. Now, what's happened is the capex really having gone nowhere and dried up. I think that that is where the next capital flows are going to. Hence why I've been making such a big deal about land owners and royalty holders in the Permian, along with obviously the oil services, particularly offshore. Once again, the thing to watch, rig supply, and there's no new rigs on the horizon to flood the market. That's what would mess up this thesis and really change things. So the companies I'm interested in, okay, Tidewater, Bore, Valaris and Transocean I own. My main sizing is in Tidewater, Valaris, okay, in the public and private portfolios that I own. I do own a little bit of rig, to answer your questions in the comments, in a private portfolio, it's nothing really to talk about. Okay, it's a very small position size. I don't even check it, to be honest. Okay, so that's just there doing its thing. These have been listed in order of EV to EBITDA. So what you're paying in terms of your estimate of end of year this year, 2025 EBITDA. So when you look at it, you compare, okay, Transocean, Tidewater's oil services, platform supply vessels, offshore service vessels, those sorts of things. So they'll run on shorter cycles. You'll see them run first, most likely, which is exactly what happened in the last cycle. As I was telling everyone was focusing on the drillers. And I was saying short cycle, Tidewater moves first, then you see the capital flows, and that's what happened. Again, that's where I see things will occur due to the short time horizon of or the short term contract cycle, 6 months versus a year or more for some of the drillers, and the fact you need usually, I believe, 4 OSVs for every decent drill rig out there. So obviously they've got some talk to play with there, and they're actually the cheapest of them all. They also really are the dominant player by far and away, having consolidated that sector. So if you're looking for the OSVs and platform supply vessels, it's really Tidewater. And the bad side about that is that those ships are a little bit easier, cheaper, quicker to build, but still set you back several hundred millions. Sigil, Bor, Noble, Valaris, Transocean. Noble looks really, really good. Looks better than where it did when I first was entering this space. Transocean, they really only have 2 wildcards, and that's their 8th gen ships. That gets brought up a lot as to why they're special. Transocean likely does super well. The issue is how much can those 2 vessels really bridge the gap between your expected earnings given the debt load that Transocean has? In other words, is Transocean really worth the 2 8th gen vessels that you're buying it for? Because if they didn't have that, you wouldn't be buying that. You'd be buying Valaris or Noble, right? So that's something you got to weigh up. Enterprise value is like 3 times Valaris, and you're getting only double the EBITDA. Okay, so essentially the 2 vessels have got to do an enormous amount of earnings power in order to really make it worthwhile taking on the debt load. For me, I just think Valaris is the easiest play in terms of it's the layup. They've got the biggest fleet overall. Yes, they got more exposure to jackups, but you're paying a third of the price of Transocean. You're paying less than Noble, and I think that they're going to have preferential treatment with their joint venture with the Saudis in terms of getting those jackups to market. So Valaris for me is pretty straightforward, although if I was looking at this sector and I hadn't allocated any capital yet, Noble does look really, really good. No doubt about it. Okay, so I've made a few little scribbles here. I'll run through them quickly and then we'll look at a few comments on the presentation. So let's take a look at Valaris. The CapEx, all they're going to do is maintenance CapEx. Okay, cash goes straight to the bottom line. I love this thesis. In 10 years or more now in being an investor of some description, private, public, entrepreneur, investor, the easiest path you can have between revenue and take to the bank profits, the better. So that's just me. When we look at this here, you got such a shorter distance between the free cash and the net income. You'll notice the free cash is actually lower than the net income expected. So they've got some non-cash items going on there. The point is their revenues are growing expected at double digits, but look at their EBITDA and their net income, okay, so after taxes are really blowing out. So they're growing at 3 times the rate of the top line, okay? And they got no debt anymore. They've already said they're not going to, no one's going to buy new ships until day rates are at $750. You can see my previous video where I break down the maths. And so all they got to do is give capital back to shareholders. And they've already said, they've already got $300 million allocated in the chamber to buy back the company. And at the moment, as you just saw with those previous numbers, bring them back, 300 million is, I mean, it's a tenth of the enterprise value at the moment. So that alone should really be really give you a big boost as a shareholder. As we compare it to Transocean here, so their capex is going to go up. They got to get some of their cold stack vessels, if they ever come out, they've got to spend an absolute fortune on those things. Their idle rigs, they've got to spend a lot on. They got a lot to spend, so they've got a harder time from, if you think about it, the journey of a dollar from revenue to all the expenses, blah blah blah, to the bottom line to coming back to you as a shareholder. It's a bit of an obstacle course, let's put it that way. And so that's why you will see, I've highlighted here the difference between the free cash and the net income expected. I mean, it's a big, big difference. So why is that? Because they get the free cash, but they can't dish it all out to shareholders, really. They've got all their maintenance, all their capex, and they've got the debt service. That's the difference. Tidewater really looks good from here. It's very similar to Valaris. It's the Valaris of the service vessel space, in my opinion. So you can see the rate of growth between the revenue, the net income, or the revenue, the free cash flow, and then how much of that free cash flow is coming back by the way of net income. I really think that's the most simple way to look at it. Think about that journey of the dollar from the top line through to the bottom line. How hard is it to arrive in your bank account? Okay, we're going to make it easier on that dollar, or we're going to make it hard. Earnings, all I wanted to showcase here was how way off analysts have been with these types of companies. So don't read into too much about the analysis. You really got to do your own due diligence always, but particularly when it comes to this type of play. That's all I wanted to show there. So Valaris here in their latest update, if we go back to when I originally share my screen here, my original presentation of Valaris, here we go. Here's where day rates were hovering. Okay, now if we jump back, share something else, we can see the difference between the two. Hasn't played out quite as well as they were expecting. In January 24th, when I made that video, as of the most recent presentation, floater rates and jackup rates are doing a little better, but floater rates are a couple of grand a day softer than when they thought they would be. Again, they're not going bankrupt. It's not exactly the end of the world. I really don't think calls for panic stations are justified. And this table here, yes, you do have to take it with a large grain of salt, but it does illustrate essentially the thesis in a nutshell. So where you can get the different vessel rates and where you can end up in terms of utilization, what would that look like? Now, obviously, it's still going to get there, but if we were to wait that out a couple of years, if we can get, and I really do think scenario C here, I can definitely imagine that happening without too much difficulty. Your free cash, which remember, by that stage, they'll bought back a lot of the company. Okay, so the company may be 10, 20% less shares, so 10, 20% cheaper than where it is today on a market capitalization basis. 10x, why would that not trade for 10x free cash flow? Of course it would. It's traded that way in the past. Transocean has traded that way in the past, with its balance sheet being way worse than these guys. So you're looking at, let's call it 16 bill. 16 bill is an 8x from the current market cap today. If that cap comes back, it probably ends up being a 9 or a 10 bagger. So I really think nothing has changed enough to derail the thesis. So that's the updated version. Let's take a little trip down memory lane for those of you who are sticking around and are interested. So nothing's changed here. CapEx ticking away. Oil break even leads offshore to being the no-brainer play in terms of where this oil is going to come from. New drill ships, remember, they were costing sort of 1 billion as an estimate last year. That's only gone up. That's 1.1, 1.2, maybe 1.4, depending on who you talk to. And that in turn drives the necessary IRR day rates, okay, the necessary day rates to achieve the IRR for companies to start to order new builds as opposed to dish capital back to shareholders. It's going to be well north of 700, might even be 800 a day by now for the drillers. Jackups, still on track. We're a long way away from 200k a day rates. Once we get to 225, I'll start to look at perhaps unwinding some of my positions in this sector. Thesis in a nutshell: this is what they have retired a couple of vessels, but they've also bought back stock. At the end of the day, new build value is now looking very close to what that scenario C free cash flow at a 10x multiple looks like. They're basically the same now. So we're starting to get more confidence that somewhere in the mid to high $20 billion worth is what a potential market cap would look like for this company. Okay. So this is the only one I wanted to share before we move on, and that is, okay, how long would you have to wait? So January 3rd, I think it was 2024, the stock price was around 68.40. Okay, at the time, an exit target of around $200. Now since then, obviously the stock's basically been cut in half. I've been selling puts and adding down in my usual manner. How long, if I get this payoff of $200, how long might that take? 5 years, 10 years? Who knows? So at 5 years, I'd still be getting a 24% IRR return. Remember, this company, I'll say it again, no debt. That's the real risk. It's got if a company's debt loaded. This company doesn't have any, zero. The only thing it's got to do is buy back its own stock. And so I think that, am I happy to wait 5 years doing nothing and then all of a sudden we get a bull market and sell into that strength? I can see that happening. We can see that happening for sure. New build cost is only going up since I wrote about it. That was estimated at $342 a share. And 5 years, 38% IRR. Okay. So lots of action in terms of the market price. When you break it down into the fundamentals, they've kind of gone flat to slightly up. That's all. So that's it, guys. Hopefully you enjoyed that. Make sure you like and subscribe to the channel. I look forward to catching up with you in another episode shortly. Take care.